in the talk that we're going to have in just a bit, we will be delving into how do you actually do reporting for crypto assets as it is developing. So to tell us more about this, we're so happy to have with us Karthik, Rajeswaran, VP of Product from HQ.xyz. Can we put our hands together to welcome Karthik, please?
Good afternoon, everyone. Just want to check that you can hear me loud and clear. Cool. All right. So my name is Karthik. As mentioned, I lead the product development team at a company called HQ.xyz, and I'm going to speak to you a little bit about crypto accounting this afternoon. Now, before I get started, a quick show of hands. Who here, either in their personal capacity or as part of their organization, holds any crypto or digital assets? Okay, decent number of people. Next question. Who here enjoys accounting or auditing? Okay, a very small number of hands, so there's some overlap here. Okay. Now, one of the big, themes of our time is that the Web3 industry and space is entering a new era of financial accountability. Right? Now, by that, what do we mean? There are two components to this. There's the basic elements of actual financial reporting and compliance that comes into play, but then there's also the internal ability to have a clear understanding of your business, your assets, and how to treat any digital assets that you own and hold, right? Now, we're all aware that unfortunately a lot of the recent market downturns have been attributed to a lack of financial oversight and accountability, right? In the past year, we saw the biggest example of this being the collapse of FTX. And a lot of the reasons for that were purely down to basic fraudulent activity. It had little to do with cryptocurrency or the blockchain in and of itself, right? It was basic fraud. And simple ways that this could have been avoided is if accountants and or auditors who are looking at the books or even internal people within the FTX team had clear line of sight into exactly what assets are held where, how money is being moved around, and who it's being paid out to. Of course, we also saw the same thing happening with Three Arrows Capital, who are a big VC firm. We saw this with Terra and Luna as well, and there have been many other cases of this over the years. So, as a primer, even before we get to a lot of the problems and some of the solutions that we at HQ.xyz are bringing to the table, I'll start with an overview of how you should account for the digital assets that you own or hold. All right? So, fundamentally, as digital asset adoption continues to rise, organizations and individuals, but predominantly focused on organizations, have a need to account and incorporate them into their basic financial reporting. We're talking about income statements, balance sheets, profit and loss statements. And fundamentally, they need to be as accurate and complete as your traditional fiat assets or any other assets that you would hold on your balance sheet. Unfortunately, there are many challenges, right? First and foremost, most digital assets are still priced in fiat currencies, and on a fiat basis, prices fluctuate wildly. They can fluctuate over a period of weeks and months, but sometimes even in days and hours, right? So how would you actually record that on your balance sheet and treat it? Secondly, as briefly alluded to, there's a lot of complexity involved. Now, when you have assets like NFTs or DeFi use cases such as staking, liquidity pools, and others, that have multiple parties involved in the movement of assets or funds, as well as multiple contracts involved as well. How do you actually treat this, right? It's not straightforward. And then fundamentally, this is more of a generalized accounting and taxation problem, is that there are inconsistent standards across the board, right? So if any of you are involved in, again, financial accounting, you'll know that there are two major reporting boards that exist around the world. There's GAAP, Generally Accepted Accounting Principles, which is very US focused, and IFRS, which is the International Financial Regulation Standards, which is used pretty much in the rest of the world, right? And also then, depending on where the entity is domiciled, different tax rules apply, both in terms of the actual amount of tax applied, but in terms of what types of assets, crypto and digital assets, are considered, right? So let's come to the question then of how you actually treat these digital assets. This is an open-ended question, right? There's the initial recognition. Do you hold and treat them as cash, as a financial asset, as a fixed asset, as inventory, or as an intangible asset? And then once you've put it on your balance sheet, what about the subsequent measurement, right? Do you treat it at fair market value, at the initial cost of acquisition, or is it fair value minus impairment loss? Now, this is getting into the weeds of accounting a bit, so I hope it doesn't bore you too much. But there are general frameworks applied, and this is sort of as of a few months ago, by the different standards around the world. Now, I won't get into it in too much detail, but as you can see, there are different approaches based on the accounting standards applied. Some of them are either treated as intangible assets with an indefinite lifespan, or in some cases as inventory. And then the movements or changes in value of the assets as well are treated completely differently. So if you were to go and ask one accountant and then ask another accountant, you would most likely get different answers. And as such, a lot of people are simply afraid of delving into this space at all. But it will come back to bite them if they don't pay attention to it. Now, the FASB are the Financial Accounting Standards Board in the US, and they've actually come forward with a new set of proposals. Now, this is very recent, so this was put forward at the end of Q1 2023 and as an open request for comment to the industry. So the existing treatment in the US is that crypto and digital assets are treated as indefinite-lived intangible assets. Now, what that means is that crypto assets are initially recognized at the cost they are acquired at and then subsequently tested for impairment. Impairment fundamentally means whether their value has changed, and it's usually as an impairment loss. This was actually only required to happen once a year. But now, as we all know, crypto assets don't change in price only once a year, right? This is constantly happening. These are 24/7, 365 markets. And the nuance here is that only decreases in value below the initial cost would be recognized. So if you acquired ETH at a price of $10,000 and its price dropped to $8,000, you are allowed to recognize and update that value. But then if it subsequently increased to $9,000, you are not allowed to update that value on your balance sheet, which is, again, incredibly confusing and really doesn't make sense, right? Fortunately, the new proposal means that it is being updated to be treated as an intangible asset measured at fair market value. So this will then mean that whether the value increases or decreases, you'll be able to account for it accordingly on your balance sheet. Any changes in fair value would need to be reported on your net income statement, right? So this means then that whether you're a crypto exchange as a business and have your balance sheet changing constantly, or as a normal business, you can meaningfully treat the crypto and digital assets that you hold as part of your inventory as an intangible asset on your balance sheet, and pretty much be able to report in real time as well. The longer-term effect or benefit of this is that it makes it easier for any business operating with crypto and digital assets to get access to capital. So if you need to take out a loan against the balance that you hold, you can do so in a more realistic and accurate manner, right? Now, getting into some of the specificities, what exactly do you have to account for? So the screenshot you see in the background is a preview of our product, which I'll get to a little bit later. But fundamentally, this is not unique to crypto, right? This is standard accounting that you would experience with any assets you would hold. The activity type, the category or chart of accounts that you need to map the activity to, the cost basis method is something you'd need to keep in mind, the gains or losses of the assets that you've acquired, as well as the payee and payor details, fundamentally who it was sent from and who received the assets. So specifically now, taking into account the type of activity, right? What you would need to be able to do is, if your business has a chart of accounts and categories mapped to wages and salaries, refunds, anything you've paid to a vendor, you need to be able to automatically detect and categorize that, even if it is on-chain activity. So you'd have to be able to account for NFT mints, purchases and sales, for crypto swap fees, for gas fees, and the like, right? And of course, in the cases where people are actually making payroll, you'd also need to account for it accordingly. Additionally, a key element of any accounting and taxation methodology in particular is the cost basis method that you use. Now, I think the one that people will be most familiar with and that is most intuitive is the first in, first out method. So fundamentally, you acquired an asset one day and you chose to sell it a year later, but then you acquired multiple, let's say you acquired 10 ETH over a period of time. The moment you sell one, it'll be treated as the first one that you acquired and the first one that you sold. So that will be the cost basis, and you can optimize for your tax treatment accordingly. The good thing, though, is that the way in which you build products should allow for multiple different ways of tax treatment, right, and cost basis methodologies. And again, like I think these vary in different parts of the world and depending on the accounting treatment you choose to use. But the most common two that we keep coming across are FIFO and weighted average cost. Additionally, a key point is the source of price data that you use, right? So now you have multiple different exchanges and sources of data such as CoinGecko, Etherscan, and many others. And if you were to go and ask different people, they may say, hey, I got my price data from this source, where is the consistency in all of this? So I think whatever happens at the end of the day, you need to be able to know that you're using a singular source. And as such, whenever you go up for auditing or when you need to submit your taxes, you can always point to the most consistently used source across the industry and the most trusted source across the industry. And finally, at the end of the day, all of your on-chain or let's say blockchain data and ledgers need to translate into traditional financial reporting documents that are used, usually by your management team or even for your directors, right? The three most common ones are your income statement, your cash flow statement, and your balance sheet. You'll need to do this on a periodic basis, usually monthly, quarterly, in some cases annually as well. The key thing to bear in mind, and I guess where headquarters comes into play, is that accounting for digital assets should not be a hassle, right? It should be as easy. Even if traditional accounting is not easy or straightforward, we want to make it as easy as that and hopefully even better going forward. So in a nutshell, our pitch here is to say goodbye to using spreadsheets, right? Whether it's Excel, Google Sheets, or doing any manual work, we want to make sure that you have a singular place to have a view of all of your assets, be able to do all of your bookkeeping, and automate payment workflows as well, all right? And how that happens is through deep integrations, both with fund sources so multiple different wallets and self-custody solution providers, as well as all of the accounting tools and platforms that you'd use, whether that's Xero, QuickBooks, and many others. Coming into the specific aspects of this, so what you can see over here is that in our product at the moment, you have the ability to toggle between multiple different blockchains that you would want to get set up with, connect wallets from many different sources. So irrespective of where you hold your assets, it could even be centralized exchanges, you can feed all of that into our platform, get a singular view of everything that you hold, and then go ahead and do all of your bookkeeping, meaning assign all of your transactions to the relevant chart of accounts and categories as needed, be able to export this data into Xero or QuickBooks or any other tool that you use, even if that ends up being a manual spreadsheet tool. And of course, the end goal for us and why our name is headquarters is that we want to be the one place or one headquarter for you to operate your entire business, particularly if you are a Web3 team or company, right? Getting into some of the specificities here, this is a preview of our HQ ledger. So you get a clear insight into who payments were sent from, who received them. You can turn blockchain addresses into a human readable format simply by saving somebody to your contact book or addresses. It's very clear to see what amounts were spent on the actual transaction versus the gas fees incurred on the transaction that was made, right? It will automatically account for the different cost basis methodologies as well in terms of determining your gains and losses calculations. Also, values here, or the relative fiat values, are configurable and are usually presented in a mark-to-market manner, right? So whatever the fair market value is at that point in time. However, there is flexibility for you people to go in and adapt or update those values as needed. And of course, a key aspect which we don't play up as much because we feel that our core competency and focus is on helping you with your accounting and reporting. But it's incredibly easy to make payments and bulk payments in particular on our platform as well, right? So we work with trusted custodians such as Safe and Fireblocks and are powered using Disperse, who have made it incredibly easy to make payments. It also saves you gas fees when you make payments such as these in bulk. And a key use case for this is people making payroll, right? A lot of our clients at the moment make payroll in stable coins. And so if you have a globally distributed team, we make it incredibly easy for you to make your payroll in your stable coins or any other token or asset you wish, and have everything automatically reconciled in our platform, right? And yeah, that's HQ and crypto accounting in a nutshell. If you like what you see and you'd like to get started and try out our product, you can do so by yourself by going to our website, www.HQ.xyz, and signing up. But the more preferred method would be to reach out to either our CEO, Sharon, or Noel, who's in the crowd with me today, who leads our go-to-market and partnerships efforts. They will be more than happy to help you with a personalized onboarding demo call and setup, and help you connect all of your fund sources and get going. Thank you. And we do have a few minutes left, so I'll open it up for questions if anybody does have any. Yeah. Thank you.